If you're an option seller, or you want to be, then you need to understand one thing. We're not really trading stocks. We are trading something called volatility. And volatility isn't random. It's not just chaos. It follows real patterns that you can measure, forecast, and use to your advantage. So in the next few minutes, I'm going to walk you through 2 truths about volatility that every serious trader needs to know. And once you see them, it'll change the way you view option trading forever. So first up, just a quick refresher to make sure we're speaking the same language. Volatility is just how much a stock price moves over time. If there's big swings in the price movement, that would be called high volatility. And if it's pretty steady, low movement day to day, that would be low volatility. When looking at options, volatility determines pretty much everything. How much the option is priced at, how much the price of the option changes in the future, how the option is going to decay in value, and how it could expand in value. So without understanding this concept, you're kind of flying blind. All right, so the first big truth that you need to understand about volatility is that it is mean reverting. And what this basically means is that volatility isn't just randomly changing in value all the time. It actually operates within a range, and it tends to oscillate around a long-term average value. And this kind of makes sense if you think about it, because volatility is by definition range bound. For example, volatility literally cannot go lower than 0 because the least amount that something could move is not at all. And then when it spikes super high, whether it's due to something that Trump tweeted or some other form of market uncertainty, that level of volatility isn't usually sustainable, and we'll see a reversion to some sort of normal or average, right? Eventually things go back to normal and volatility goes back to its usual day to day. Just like when you stretch a rubber band too far and it snaps back, that's kind of how volatility works. And here's why this matters when you're selling options. When volatility expands, so do option prices. We see the premium of options also go much higher. And when volatility falls, we see the same thing happen to option premiums. They tend to contract. So when you see option premiums increasing rapidly, there's an implicit assumption that future volatility will be much higher. But we also know that eventually it's going to come back down. Now, knowing this concept, it sounds like volatility trading and buying and selling options should be pretty simple. When option prices go high or volatility expands, we should be selling it. And when volatility contracts or comes down, we should be buying it. But it's not that simple, because think about this. Volatility, when option premiums increase, there's an implicit assumption that the future volatility is going to be higher. We know that eventually it'll come back down, but the question is, when? And when volatility is low, we know that eventually it'll go back up to some sort of average, but once again, the question is, when will this happen? And this leads us to the second characteristic that we need to understand about volatility. And once we understand this one, the first one is really put into context, and it allows us to start thinking a little more strategically about how to trade options. The second behavior that you need to know about volatility is called clustering. Volatility doesn't really just flip from low to high every single day. In fact, it tends to stay similar over short periods of time. If a stock was very volatile today, the odds are it's going to be very volatile tomorrow. If it was calm today, probably calm tomorrow. And this matters because it helps us set short-term expectations for price movement. You can kind of think about it like weather. If today was 85 and sunny, it's probably not going to be a snowstorm tomorrow. And it's kind of similar with volatility. Today's conditions tell you a little bit about tomorrow's conditions. So here is how to use these 2 characteristics together. For every single ticker, volatility and option prices usually have some sort of long-term average that they mean revert around. When they go higher than that average, they tend to come back down to it. And when they go lower than that average, they tend to come back up to it. But it's not as simple as just saying, oh, it's above it or below it, because they also cluster, meaning when it goes above that number, it can stay up there for quite some time, eventually coming back down to it. And when it goes below that number, it can stay down there for quite some time as well, eventually coming back up to it. So when we find ourselves in periods of low volatility, where implied volatility is maybe higher than realized, that's usually a good time to be selling options, because implied volatility is a pretty good indicator of future volatility. And if we're seeing that spread there right now, volatility is pretty low, it might be a decent time to be collecting some premium. And if we're right at the start of a major spike where realized volatility is really high right now and implied volatility just can't seem to figure it out, everything's spiking, maybe it doesn't make sense to start selling just yet. Sure, you might not be selling the top, but if we wait a little bit, get a sense of where things are, wait for things to calm down just a little bit even, we start to get a better picture of what the fair value of options are. Now within Predicting Alpha, we run 5 systematic option selling strategies that take advantage of these types of characteristics. And so if you're learning about option selling and you want to join a community of serious traders and get access to a few cool strategies, feel free to click the link in the description of this video to get a 7-day free trial with us. You'll get full access to all of our strategies, you'll get to join the community, and you'll get the tools you need to run them like a pro. So to wrap it up, volatility is not random. It's actually patterned. Mean reversion and clustering. There's periods where volatility goes high and stays high for a while. There's periods where it goes low and stays low for a while. And then there's that long-term average that it always comes back to. And once you understand this, you're not just trading blindly, you're starting to stack the odds in your favor. And that's how option sellers build a real business that lasts.